Hi, I'm CPA Dan Dickson with freeaccountingschool.com. This is Lesson 4, Part 2. I filmed Lesson 4, Part 1 over a year ago, but I wanted to come back to this topic and teach a little more about it to clarify and solidify some things in your mind. So this should be a pretty quick lesson, and in this lesson we are going to, number 1, review the 3 types of accounting accounts again. Number 2, learn more about double entry accounting basics. And 3, do some examples that clarify why we use owner's equity accounts in double entry accounting. Because once you understand why we really use owner's equity accounts, learning the basics of accounting becomes so much easier, and you will learn so much faster and really have a solid foundation to build on. So let's get started. Okay, in the last lesson we learned that there are 3 types of accounts in double entry accounting. And they are, number 1, asset accounts. These are the records that track the stuff your business has. For example, you could have an account called cash and bank, and another asset account called truck, and another asset account called loan made to Michael. The second type of accounts are liability accounts, and these are records that track what you owe other people. An example of a liability account might be loan from bank or payroll payable. By the way, payroll payable is an account that is used to keep track of the money you owe your employees. And the third type of account are owner's equity accounts. And owner's equity accounts record the effect that transactions have on the wealth of the owners in a business. An example of these type of accounts are sales revenue, or phone expense, or payroll expense. And the owner's equity type of accounts are the ones that tend to confuse the most students who are learning accounting. Some students are just really confused why owner's equity type of accounts are used at all. So let's do an example. Pretend you have a window washing business and you get your first customer and you go and wash their windows and they pay you $200 in cash to wash all the windows because it was a pretty big house, so $200 was fair. So now you open up your notebook where you keep your accounting records and you want to record your first sale. So now we have an increase of cash in the business, so we first flip to a page with your cash account on it. And what type of account is cash? It is an asset account. And to show an increase in an asset account, you make the entry on the left side. Next, you flip to another page in your accounting notebook, and on this page you find the account called sales revenue. Or maybe it is called window washing revenue. You have a little bit of flexibility in what you call your accounts. Now, what type of account is this? It is an owner's equity type of account. Remember, owner's equity accounts show how these transactions that you have in your business are affecting the wealth of the owners of the business. And in this example, the owner is you. And so your wealth just went up by $200. You are $200 richer. So for owner's equity type of accounts, to show an increase in the wealth of the owners, you make the entry on the right side. Remember, in real accounting records, you would put a date and a description as well in your accounting notebook, not just the dollar value. Let's do another quick example. Let's say in your window washing business, your local city government says that you need to buy a window washing license before you wash any more windows. And let's say the license costs $100. Well, how would you record this entry? You would go to the cash account and show a decrease of $100. And now you need to record that you are $100 poorer. Thanks, government. So you would go to another account, and maybe this one is called licenses, or maybe it's called licenses and permits. And you're going to make an entry there. Now, what type of account is this? This is also an owner's equity type of account. And you have just become $100 poorer. So to show that you are now poorer in an owner's equity account, you make a debit. And debits are made on the left side of the T account. So why is using this owner's equity account helpful? I mean, isn't it kind of stupid that we have to record that we got $200 in cash, when we first made our first sale, and then we had to record in a separate place that the wealth of the business owners went up by $200? I mean, isn't that kind of obvious? Why do we need to record what is happening to the wealth of the owners in a separate account? I mean, an account separate from the cash account. I mean, if money comes into the business, the owners are getting richer. And if money is leaving the business, the owners are getting poorer, right? Well, actually, the answer is no. Just because you get money into your business, it doesn't necessarily mean the owners are getting wealthier. And just because money leaves the business, it doesn't necessarily mean that the owners are getting poorer. In our first example of this lesson, when money came into the window washing business, you, the owner, really were getting richer. And in our second example of this lesson, when money left the business, you, the owner, you were getting poorer. But sometimes you get money into your business and it isn't an increase of wealth to the owners. And sometimes money leaves your business, but the owners aren't getting poorer. Let's do another example to show you what I mean. Let's pretend that in your window washing business, you now want to get a bigger ladder so you can wash really high windows. And therefore you could charge your customers more money for doing these higher windows. So let's say that a really tall ladder that you need to do this costs $400, but you just can't afford it right now. So you go to your rich Uncle John and he gives you a loan of $400 in cash. Let's do the journal entry to record this loan. First, you go to your cash account and you record that your cash is going up by $400. Then you go make a new account called Loan from John. And Loan from John is a liability account. And for liability accounts, to show an increase in a liability, or in other words, an increase in debt that you owe other people, you do an entry on the right side. And an entry on the right side of an account is called a credit. Okay, so in this example, your cash increases by $400, but are you, the owner of the business, really wealthier or richer by $400? No, you aren't. You have $400 more in cash, but you also have a $400 debt you owe your rich Uncle John. So you aren't any richer and you aren't any poorer from an accounting perspective. Using all three types of accounting accounts, asset accounts, liability accounts, and owner's equity accounts, you will be able to quickly generate reports from your accounting records. And these reports will help you know how much stuff your business has, how much you owe other people, and how much wealth the business has for you, the owners. Now, these reports you will generate from the accounting system aren't perfect, but they are still very helpful for business owners and business managers. And we'll learn more about these reports in future lessons. In our examples we used in our lesson, it was easy to see how the wealth of the owners went up or went down just by looking at the cash account. But once you start having dozens or hundreds of transactions in your business, then if you're not using double entry accounting with all three types of accounts, it would be really tough to quickly see why the wealth of the business owners was going up or down. So that's it for this lesson. Thank you for joining me today. Check out freeaccountingschool.com to see all the lessons available and consider subscribing to my YouTube channel so you'll be alerted when new lessons become available.